Today, I am delighted to have as our guest Professor Didier Sornette, who was a professor at ETH Zurich, or the Swiss Federal Institute of Technology, until his retirement in 2022. He is currently Dean of the Institute of Risk Analysis, Prediction and Management at Southern University of Science and Technology. Professor Sornette is renowned for his 2002 book, Why Stock Markets Crash, which looks at crashes with a deep quantitative premise, and there is an updated 2017 edition. Professor Sornette, thank you so much for joining me today.
It's my pleasure to be with you.
I wanted to ask you, in a way that you do some very complex calculations and work but I want to ask you for our audience, and then for myself as well. What is the secret sauce behind your predictions, and what makes them so powerful?
Actually, it's very simple to understand conceptually, right? So when I teach my students and also give seminars and so on, I stress that everything in finance is built on the premise of stability. It's called mean reversal. And mean reversal means also negative feedback. That's another technical term. Means that when the system goes away from equilibrium, the forces of arbitrage will push back the price to its fundamental value. Another example, which is a bit amusing or naive, is suppose you have too many rabbits procreating and the population is exploding in a valley. Eventually, there's not enough grass and the population will collapse back, will be pushed back to a kind of carrying capacity level, mean reversal. And you may remember that before the crisis of 2008, Alan Greenspan and many pundits were thinking that they have tamed the economic beast by this wave of financial innovations and so on, and that indeed market will be self-correcting. And I always remember vividly the testimony of Alan Greenspan to Congress after the great financial crisis saying, I've realized that I've made a big mistake in my life. I thought that mean reversal, self-correction was the core of how financial markets work, but this is wrong. So this is actually the introduction to explain to you what is the core behind my methods and my techniques, which is the idea, very simple, that essentially almost all engines, we say, powering financial market are pro-cyclical, we say, pro-cyclical. Another term is positive feedback. What does it mean? It means that when there is, let's say, an increase of price, rather than demand decreasing, which would be leading to a conversion to the equilibrium, demand increases. Can you imagine that? Of course, supply increase. You have the Econ 101, where you have the crossing between supply and demand, establishing the equilibrium of price and equilibrium of supply and demand. But actually, often it is a case that as the price increases, the demand increases. And it gives rise to these transient bubbles, momentum that accelerates. So the key of if you call it the secret sauce, is to realize that financial markets are inherently unstable, subjected to this pro-cyclicality, this fundamental positive feedback. And this is what we are trying actually to catch and to decipher among, of course, a large dose of stochasticity and complexity. But let me just give you one example of a very simple example, or two simple examples of positive feedback and pro-cyclicality. So you mentioned before in our private conversation that you have traded options. And suppose I am a seller of an option. I'm going to sell you a call option. Okay, you are a kind investor, you buy my call option. So what I'm going to do is to, of course, hedge my risk. And the Black-Scholes theory formula, famous, gave the Nobel Prize in 1997 to Scholes and Merton, said that you need to build a portfolio, and the portfolio works in the following way. You need to buy the underlying asset more and more as the price of this asset goes up. The more the price goes up, the more the demand for this asset is occurring. Pro-cyclicality, positive feedback. So even at the very core structure of one of the most fundamental assets that has been developed and widely, distributed in order to hedge risk, you have this procyclicality occurring. Now, what is interesting is that when you develop Black-Scholes theory and you do the pricing and so on, and of course you improve by the smile effect and all this stuff, people in general neglect market impact. But as many people, start to, for example, hedge their risk by developing, for example, what we call synthetic put options, that was a famous Leland and Rubinstein strategy that is well known to have actually aggravated the crash of October 1987. This market impact, which is pro-cyclical, give rise to this positive feedback and this instability. One example. So this is an example that I put in the domain of, let's say, technical mechanism, and there are many others. But there's another big class of pro-cyclicality, which has to do with the fact that we are humans. And humans are very social animals. And we love to imitate each other. We have even, under neurobiology, the mirror neuron. The famous philosopher at the beginning of the 20th century, Girard, developed this mimetic human description. We are fundamentally hardwired to learn and to also develop this mimetic behavior to be good together, et cetera, et cetera. I would say also it is rational to imitate, right? We are having this conversation because we are trying to learn from each other, and what I'm saying may inform some of your viewers and listeners, and of course they might be influenced partially. This is what could be, in a broad sense, called imitation. So, and a lot of neurobiological studies show that we are probably the most advanced mammals to learn by imitation, starting from baby all the way to, without hands. So all this, these are just two simple examples of, I think I've built a list of 20 or more different mechanisms that show why markets are intrinsically powered by positive feedback. And so this is the core of my answer in the simple world. This positive feedback means that, the normal behavior that is described in textbooks is not the reality. I always tell my students, everything that is in textbooks is nice, beautiful, but doesn't work in reality.
You're absolutely right, because in my career, I worked for many banks, and many of my clients were hedge funds. And what you find about hedge fund traders is they're always after, what's the hot news? What's the hot trade? Let's all get onto the hot trade. And the hot trade might last for days or weeks, sometimes a little bit longer. And then, somebody smart gets out there. Everybody's going, oh, we got out of that trade. We made our money. We're not there anymore. But this need to be, I think you called it herding, is a very, very, very powerful, that we don't want to miss out on the big trade. And I want to get your opinion on this. Is over the last, I'd say 10 years, certainly, is we have had a lot of, machine trading. And I used to trade commodities, gold, silver, and I did a little study, and I realized that, with my own, sort of basic parameters, that 80 to 90% of the trades were actually done by machine. They cut it into time weighted and volume weighted. So it became the humans didn't matter. It was just the programs. And a lot of these programs were momentum following programs. If it's going up, buy it. If it's going down, sell it. And in part, they can do that because they can get it in and out so fast. If they buy a lot, they can sell very, very quickly. So, it seems that, these machines have made the power, your sort of, LPPL law even more accurate or even more powerful.
I agree. Actually, I often make this very point. So thank you for making this remark, that actually you could imagine that having machines replacing humans, they would be more rational. You could converge better to the discovery of the real price, the fundamentals, so to speak, and so on. But you are very right. And so it has to do with how the programmers, the financial experts, actually put their preconception and the different, let's say, modules of calculation. But there is also another component that adds to what you just said. Imagine that there would be a solution, a perfect Goldilocks situation, that the machine with their supercomputer abilities and so on, AI, artificial intelligence, would be able to see. Then imagine that there are 10 hedge funds competing. They will all go to this same optimum. So that's a problem, actually. A well-functioning market is one in which everybody disagrees. You have as many sellers as buyers and so on. A market where there is too much consensus, everybody wants to buy, it's a bubble. Everybody wants to sell, it's a crash. So that's a problem with the kind of uniformity that is embedded also in the machine that adds an additional layer. Not only the algorithm tends to actually crowd into the best performing, algorithm or the best performing strategies, but also the strategies that work are not that many, and therefore, of course, they all hurt to find this optimal dynamics.
It's absolutely right. It's a and what's interesting is the exchanges have all encouraged this because they get a fee for volume. So they love volume, and if the humans all disappeared tomorrow, they'd still have 80-90% of the volume. I'm not sure they, in some ways that they really care all that much. So it's made the power of your predictions, I think, even more powerful. So I want to get into the sort of the mechanics of predicting a crash. When you look at a market or a stock, it seems to me that there's like more oscillations. Would it be accurate to say that if there's a lot more volatility, that's suggesting that the system is becoming unstable?
Very good question, because it allows me to clarify something. A few years ago, we published my longest paper ever, almost a book, 110 pages, and we found a journal that could actually publish it, in which we studied 40 historical bubbles among all type of asset, different region, and so on, and different periods. Asking precisely the question, I think that's something like the title of the paper, is volatility a good predictor of a financial crash? Or is it a good diagnostic of a developing bubbles and a predictor of the crash? And the answer is a big no.
Oh,
so
wow.
A big no. So let me explain. So this is very interesting. So what we did was various quite sophisticated, but also simple, a whole hierarchy of different methods and techniques and econometric and statistical methods. And what we found is that, and actually this resonates with the standard, let's say, knowledge, wisdom, a crash never happens when things look bad. There's a lot of optimism. Let me just make, some quotation to illustrate that. Do you remember Professor Fisher back in October 1929, just a few weeks before the great crash, then was, like 40% drop, then subsequently led to a 95% loss totally in the 3 years that followed with the Great Depression. He said, the market can only go up, and I expect actually great gains of the market, right? And the volatility was very low. Before the crash of October 1987, the Wall Street journals also wrote something like, the market can only go up. They have gone up for, let's say, the last 5-10 days. You are option trader in your past life. When you look at call minus put over put, which is an indicator out of the money proposed by Professor Bates, you can see that just before the crash of October 1987, the call are very expensive, the put are very cheap. And you can see actually this wave of pricing that inform you how the market participant feel the risk. Indeed, a year before, you can see the put quite expensive. There's a wave of panics, and then a consolidation, let's say a buying. So the price goes down by maybe minus 10%. Wow, buying opportunity. And then the bubble starts again even stronger. But close to the crash, actually, the volatility is low, and the volatility is not at all a good predictor. The volatility has this kind of, indeed, as you said correctly, a kind of accelerating dynamics in time scales, but close to the crash is very low in general, very bad predictor. And it's not a systematic increase that would tell you that indeed a kind of critical point is reached. No, the way we try to target the end of the bubble, and I should say, by the way, that we don't predict crashes, we try to identify the end of bubbles. That's very different because the end of the bubble is the end of a phase of positive feedback, of exuberance, of herding, of fear of missing out, all this stuff. But when you get to this singular point, the singularity, we don't really know what will happen afterwards. It's like, I like to take this example, it's like crossing the horizon of the black hole. You don't know what is on the other side. On the other side, there may be a crash, large drawdown, but in general, also it could be a plateau or higher volatility. So you're right. After the peak of the bubble, the market hesitates, realize that it's not sustainable, this growth. And then there's a lot of hesitation. Let me give you an example. In October 1997, that's when I was starting to write my first book and looking how to invest in options. And that's what we made a fantastic gain. I tell the story in my book. We're expecting to make 30,000% of gains on this prediction. We only made 400%. What happened is that rather than, and we made it in 1 week, but it was a very big disappointment. I remember we bought for 30,000 US dollar and we were hoping to make 10 million. Okay, so, but actually we only made a factor 4. The reason is, indeed, there was a big bubble coming up. On Monday, 27 October, the market corrected by 8%. But then rather than continue as we were expecting, rebound 5% and went sideways for 3 months with large volatility. So in that sense, I would say the forecast, the prediction was correct. Very strong regime shift compared with the previous ascent, but then a big change of regime. So we don't predict crash, we predict change of regime, the end of bubbles. Okay, first, very important point. And then, of course, as an option trader, you will realize that is very interesting because then you have the possibility to design different option strategies in order to chisel, adapt to the different scenarios that you can build based on the information that you have. So what are we using? So we are using the signature of the positive feedback. And so a keyword, now I'm giving you the second layer of giving inside information. This is what I call super exponential acceleration, super exponential growth. So I often tell my students, I'm really upset when I hear pundits, journalists, and commentators saying, oh, it's a bubble, the price is growing exponentially. Nothing can be further from the truth because everything in demographics, in economics, and in finance grows exponentially. This is the law of compounding interest, right? Everything is exponential. So the definition technically of bubbles is a transient growth, which is faster than exponential. What does it mean? It means that the growth rate, the rate of return, for example, the first year would be 10%, second year, 20%, following year, 40%, thereafter, 80%. So the growth rate grows itself. I remind you, without being sophisticated or mathematically complicated, that a constant growth rate, let's say of 10%, corresponds to compounding interest to an exponential growth, right? So a bubble is super exponential. The growth rate grows itself. The rate of return grows itself. So that's what we are actually trying to detect. In addition, and this gives rise, by the way, to the singularity. That's why I call it log periodic parallel singularity. The parallel singularity says that the shape of the growth on average is this finite time singularity, which is much faster than an exponential. Now, the first part, the key concept is log periodicity. What does it mean? It means that this super exponential growth doesn't go smoothly, but it is punctuated by an accelerated series of phases of enthusiasm, correction, rallies, and let's say mini panics. People say, okay, they realize, investors are not stupid. They realize that something is weird. They, of course, big stories, everybody is herding, credit is created, all these forces that are pushing the ball up, foreign investors are coming and so on. But there's a level where people are starting to ask questions. So there's a correction. And often the correction, can be 5%, 10%, 50%. And then it's a buying opportunity and the bubble restart. And this series of phases are approximately accelerated, and these give rise to this approximately stochastic, what we call log periodicity. Log periodicity means periodic in the so a little bit of math, of the logarithmic of the time to the critical point. So it's just a way to characterize this kind of acceleration. So it's as if, we have time warping, like in a black hole physics, where things are accelerating, the time accelerated close to the bubble. And this is what we are trying to decipher in this stochastic universe.
What kind of bubbles are we, should we be concerned about or be watching right now?
Yes. Yeah, so our indicators reveal indeed clusters of bubble-like behavior. By the way, we never know there is a bubble, right? So our indicators flag behavior that are transiently super exponential with maybe this structure of accelerated dynamics of volatility I was describing. But there is we never know for sure, right? In science and in statistics, we can only increase the probability of the diagnostic. I am a scientist, so I should be cautious in any statement. I'm giving you the caveat before telling you to answer your question. We do see indeed increasing instability on certain segments of the tech, and it will not surprise you. And of course, of the AI equity space, Nvidia, not to cite it, right, is a massive example, having passed $4 trillion and amazing, passing in, recently having more than $500 billion valuation above Microsoft. And indeed, they seem to, by and large, decouple from real fundamentals, and they do show LPPLS consistent pattern of super exponential growth and this structure of volatility. I can say also that in the bond market, we can see the continuation of signals that are probably associated with unresolved tension between central banks and fiscal and sustainability, right? Particularly in the US and part of Europe, right? So they are not yet at critical points, but deserve close attention. So this is the way. So I should say that, in terms of a risk control, because actually the best way to invest is to always do risk control. I have invented the term dynamical risk management. So the core of LPPLS and all this engine that I've described to you is to look at the risk in a very dynamical way, continuously updating, and that's what the technique LPPLS allows us to do, and to see the risk as movies, not snapshot. So I will often take this example. In order to know what is the state of health of an asset or a portfolio, it will be the same as, for example, knowing how healthy you are. For example, you go to the doctor, you have your blood taken, many samples and fluids taken and analyzed, and then the physician would put you into 30 or 50 dimensional space. You are in this point, and you say, okay, this is good, this is not so good, and so on, and we're going to give you medication to go back. This is a snapshot. But the problem is that one point in this high dimensional space could be obtained from many different paths. And it is the path, actually the movie, that really informs. And this is why in medicine, it's so hard to actually have a correct diagnostic given the measures. You need to know the path. Same thing for finance. So dynamics, movie behavior, dynamical risk management is essential. So yes, so bonds, I was telling you, and then the last one would be, of course, in the realm of cryptos, which we see, of course, sign of bubble for some assets, which are not, of course, decoupled with the recent, let's say, decision, the Genius Act recently last Friday, and the American administration, which is much more favorable, which indeed participate in the ghost story. And of course, you have all this herding behavior and the fear of missing out. That's a few examples that I can mention, where our indicators are flashing for heightened diligence, of course, sometimes to take profit, for example, for gold or maybe silver, but also to maybe serve the next leg of the ongoing bubbles.
So interestingly, I was a precious metals and base metals options trader, so I watch gold and silver quite carefully. So silver is a very, very harsh mistress. One of the worst, I believe. But it's at $39 an ounce. looks like it go 40, and then I think you'll get more people getting into it. What qualitatively, what would flash signals that it's the end of a bubble for silver, for example?
Okay, so let's see the indicators of silver, and I comment in real time what we see. Okay, so here I have the confidence indicator that shows me that, you see, we had previous signal of, for example, channel regime and a rebound. By the way, I did not mention it before, but we have also signal for rebounds, which seems to be often much more precise than the end of bubble, because it's very it's very clear to understand. The financial market have a strong bias on the upward. People see any drop as a buying opportunity. Okay, so let me now look at the different indicators, let's say from short term. So we characterize the indicators over different time scales. Yeah, so we see at the time scale from 2 to 4 weeks, the beginning of an indication that there might be a short-term correction, of this type, for example. Then I go from 1 to 3 months, okay, confirming. 3 to 6 months, a little bit. So yeah, 6 to 12 months, then 12 to 24 months. Yeah, just starting, you can see. Yeah. And 2 to 6 year, yeah. So here, silver is not finished, right? The bubble is ongoing, is growing, and it's certainly a time to get into the market. Of course, it would be better to go in the market earlier, right? At the beginning of the year, or in response to the April 2024 Trump action. Now, what we can do is we can select a time, and then we can see the distribution of potential turning points. So here we see that there are not many. There might be on short time scale, short corrections that could be a buying opportunity, but really the bubble is developing. So to answer your question, we would need the piling up of these different indicators that we call confidence indicator at different time scales to run their course. And also we plot here the distribution of the critical times, which are the different predictions of when the bubble will end.
Okay. Is there one close, like, or much closer to ending, do you think? Was it Nvidia that you talked about, or?
So let's look at Nvidia. We see that, so this is an aggregation essentially the maximum over all the different time scales of these 6 different indicators over the 6 time scale that already give me a kind of bird's view what is going on. So you see that we had early warning that the channel regime was occurring after this ramp up. Then we have had a plateau, volatile plateau. And the question now is, of course, does this rebound after April 2024, with very impressive run, with the stock actually breaking barriers, going to actually correct or continue its run, right? That's a $1 million question, or $10 trillion question, actually. Yeah. So let me go to the different indicators and blow this up a little bit. So we see here, okay, short term, just beginning. Okay, quite interesting. So it means that we might have short-term correction, profit taking. Okay, longer term, not yet. Right, okay. So for me, this is not a crash coming. So it's not a crash coming. It's probably a short-term correction followed by a rebound.
Okay. I want to study your website and understand it certainly better. Well, Professor Sornette, thank you so much for your time today and your insights. I look forward to talking again with you sometime. We can dive a little bit deeper into all the really interesting ideas and insights that we have. Again, thank you so much.
It's my pleasure. It was really a great pleasure to speak to you, and thank you for your question.